So my point being this is that, yes, we are not seeing these crazy bad financial state of the economy today. So it may feel like 50 basis points was more than necessary. My argument is that we took drastic measures to deal with inflation, which, although it wasn't transitory like they said, let's be honest, it was a lot attributed to the pandemic that was going on at the time and the aftermath of the supply chain issues and all that. So some of it was transitory. It was took a little bit longer than what they expected, right? It was like a long transit in that transitory, but nonetheless, it was still, to deal with that. Now, other things like the stimulus that was done and all the printing of money and all of those things added to the inflation as well. But a lot of it was, which was also due to the pandemic, but more of a long-term impact versus like a supply chain issue, for instance. So my feeling is the Fed's going to continue to move rates down, and the reason we didn't see a big lift is because two things. One, a lot of it was already baked into the market. If you watch mortgage rates closely, I mean, we had already improved over a point in interest rates in most products and programs before the Fed rate cut ever happened. And secondly, it's because, although he was aggressive with this first move, they didn't like the comments about, not letting us get all the way back down. But so that's kind of my take. I think the Fed got it right. I think they'll continue to be aggressive. I think they need to continue to move quickly. They probably won't do another 50 basis point drop this quickly, but in my opinion, they are behind the gun because they need to get us back to a neutral stance. The economy, in many ways, stock market and employment's not horrible. Although if you look at where it was a year ago, it looks pretty bad. But historically speaking, 4.3% unemployment is not horrible. But if they're not careful, things could go off the rails. So they need to get us back to a neutral policy as quickly as they can. And this was the right start, in my opinion. So there's my take on the Fed taking a half point, even though the economy doesn't feel like it really needed it. But we do need it, and it was the right move. Now, the other thing I want to touch on here, I got a couple slides, and I want to give a shout out to Dan Rawich, as I've done in the past. These slides come from his market mentor report that he put out. There's a bunch of slides here. I'm not going to touch on all of them, but I thought that first one was important. The other one I want to touch on, which I thought was really cool, and I think you guys will think is very cool as well, is this one that I'm going to pop up here. What this shows is that historically, and you can look at the big circles on this graph, those are when the Fed finally started easing rates. Each of those cycles is when the Fed started easing rates. Now, the two lines on here are the mortgage rates, which is in the blue, and you can see where that question mark is. They're still very high. They've come down, as I mentioned, but they're still very high. The red, though, is the effective rate of interest on mortgage debt that's outstanding. That number looks to me to be around 4%, low fours. What's really cool about this graph is that every single time the Fed has started a cutting cycle, that mortgage interest rates have crossed and or, in most cases, declined below the effective rate of interest on outstanding mortgages. That means that based on this graph and based on history, we should see mortgage rates at some point in this cycle cross over that red line, which would probably put us in the low fours. This is the first graph that I've seen that really would give you any sort of historical measurement as to why it would be logical rates would go into the low fours. Now, a lot of people say that they think that they will, but I've never seen it illustrated in this way. So I wanted to show you this graph, and it gives me some optimism about where rates could go.